I know the distributed market ends up getting a lot more coverage relative to the utility space as of late, but there's, as Shale mentioned earlier, the reality that the utility scale market still is driving the majority of growth year over year over the past couple of years or so. And actually, back in 2013, we saw about approximately 2.8 gigawatts installed of utility scale solar. And that's, not only impressive, but record-breaking. And amidst a lot of this gigawatt level growth, which is ultimately impressive, procurement of utility scale solar in the US has begun to wane. And amidst that as well, we're beginning to see PPA prices hit, what may not be dangerously low levels, extremely aggressive levels that bring up a lot of questions about how to access financing when PPA rates get into the low $50 per megawatt hour. And so we have 3 great panelists here to cover some of the key questions that will allow developers and other key players in the market to continue to see growth amidst this waning demand from the RPS standards in the near term, as well as the impending reality of the federal ITC's expiration. So I'm going to let my 3 panelists briefly introduce themselves, and then we'll jump right into it.
I'm Fazli Qadir with Hecate Energy. We are based in Nashville, Tennessee. By way of background, Hecate was founded about a year and a half ago as primarily utility scale, but overall solar developer. Prior to that, the founders of Hecate were the founders of a company called OCI Solar Power, which we had founded in 2009 and then exited in 2012.
Morten Lund. I'm with Stoel Rives. We're a law firm with a significant renewable energy practice. I myself have been working on energy matters for finance and development for 20 years now. Last almost 10 years, I've really been focused on solar energy almost exclusively because, I take my hippie moment here while I can, because while I was working on coal plants and other things, I quickly recognized that solar energy, frankly, alone among all the energy technologies we have available today, can truly transform how we think of and use energy. And I'm frankly excited to be part of it. And so this is what I've been doing now for basically the last decade, developers and financing. That's me.
Thank you. So Peter Davidson, I'm the Executive Director of the Loan Program Office of the Department of Energy. Very pleased to be here, just in general to be here, but also if I can, I'll take 2 minutes to talk about a major announcement we made today, which is the Loan Program Office issued in draft form a new renewable energy and energy efficiency solicitation for up to $4 billion of loan authority for renewable energy projects and energy efficiency projects. Secretary of Energy announced it this morning at a speech in Georgia, so I'm here doing the same thing. And it is $4 billion of loan authority. We're doing it in draft form today. We have 30 days of public comment, 45-day period of congressional comment. So I hope you'll all go look at the solicitation. It's at lpo.energy.gov, lpo.energy.gov. And I think we'll talk a little bit later about the ways that the Loan Program Office was very involved in financing the first projects in PV solar, utility scale PV solar, and then utility scale concentrated solar power. So we see this solicitation, particularly one of the areas we've drawn out to focus on are the areas of grid integration and grid storage. And we really see that as a very key next step in the evolution of the utility scale side of solar, and all solar, but particularly for utility scale. So maybe we'll come back to that later.
Yes, definitely. Okay. All right, thanks. And yeah, the loan guarantee program, looking forward, that'll be a big part of the discussion. So first question, I'm going to start with Fazli with the lens of a developer. And I noted earlier about the challenge that a number of pure play developers have in replenishing their pipelines. And I'm curious if you could speak to, what do you think is the biggest challenge right now to developers being able to replenish their pipelines, and how does a developer deal with that? And what are some of the key strategies to ultimately cope with these challenges?
Yeah, so primarily the challenges are what we would expect in a market that is finally, that has attained critical mass, and where the number of utility deals coming out is a lot lower than it was a few years ago. But that said, we have still been able to, at least within our group, have been able to be proactive about seeking deals. So there are ways to wait for RFPs to come out, and then there are ways to proactively go out and promote a deal as long as it makes economic sense for the utility as well as for the developer. So I think it has slowed down, definitely, but there is a way to be proactive about it and go to areas and to geographies where solar has not traditionally been huge.
Okay. And so along the lines of being proactive, one example is, geographic distribution and what you seek out. Is that really the key strategy for navigating a lot of the waning RPS-driven demand, or is, bilateral negotiations an equally valuable strategy too?
Well, absolutely. I think both of them. And we are involved in certain bilateral negotiations again, but it's again in geographies where solar has not been traditionally that big, or the RPS is driven.
United States or not United States?
The U.S.
Okay, 'cause I think
So so I'm talking about U.S. right now as well, but we have, as a developer, we have been diversifying overseas as well, but I don't think Cory's question is currently related
No,
to that.
that's fair. Yes. So I imagine in terms of geographic distribution, which particular markets have held an attractive opportunity? I know that, for example, with Georgia and a lot of other examples of utility-led procurement at the bottom-up perspective, as opposed to just from a state-level RPS-driven demand.
Yeah, so there are certain markets that we're looking at in the Midwest right now that do not have any significant RPS-driven demand. So we are going, and again, it is a function of where current pricing is in those markets for electricity, and whether you can make solar work. So solar is competing with other forms of energy, plus there is the component of renewable that you can marry to it, and whether that provides a compelling enough opportunity, or that somebody would go for it. So it's harder work. It's not the old days from 5 years ago, or that it was, which I felt was relatively easier. It's harder work, but I think the deals are there.
Okay. And so how does that work, with now ultimately, PPA terms perhaps getting tighter alongside the pricing? Morten, with the work that you guys do with developers and structuring financing, what are some of the key challenges that come into play in making projects that do work that utilities are procuring right now?
Well, I think that the real first threshold question is really to define what types of projects we're talking about.
Right. So keeping in mind that this would be perhaps two separate conversations for, let's say, projects that are in the 1 to 20 megawatt range versus perhaps whatever remaining procurement happens in the 20 to 100 megawatt spectrum.
And there, I think that perhaps even then the question is less about, it's difficult, you can certainly finance a 20 megawatt project. It's more difficult to finance a 10 megawatt projects. But we would much rather combine a couple of those to get at least up to 40 or 50 megawatt into a single financing. But even then, there's another threshold beyond that, as we were discussing earlier. There comes a point, let's say 100 megawatt combined asset size, where financing just is not an issue anymore. The development challenges are still significant, but once you get above a certain level, the money will come. If you can get to the point of finance ready, then the money will come. That's not true for a single 20 megawatt project. It's probably still not true for 50 megawatts of combined assets. But there is a point where financing just, it's certainly difficult and expensive and has to be done, but getting it is no longer the challenge. But now if we're talking about in that 20 megawatt or 20 to 40 megawatt lump, there, it's really, you have to understand, you're now competing for money. And if you're competing for money, then all your development features, so to speak, have to be extra good. And now all of a sudden, of course, your documents by now have to be airtight, otherwise you wouldn't get this far. But all the other kinds of soft risk and environmental risk, all that stuff has to be extra good, because you're not competing for money against in a relatively limited pool of providers for tax equity. That's really the money we're talking about here, right? It's tax equity, and so you really have to actually compete on development value as well as the economics of the project. If your debt service support capabilities is greater than your competition, then that's good. If your off-taker has even that much better credit than the other guy's utility, your utility has a better utility or has more experience with solar or otherwise has a good track record of getting stuff done, that starts mattering at that point. But only in that tranche, right?
Okay.
Above there it doesn't matter. Below there, you're not really in the utility scale competition either. So it's
okay. So I want to go back to the 1 to 20 megawatt range because we didn't really dive into that.
1 to 20 megawatt. That's like 5 different markets.
It's a different market perhaps. But before I shift over to Peter quickly, there were a lot of things at play that you were explaining there. But in the sort of key takeaways of the difference between sort of financing the 20 to 40 megawatt project versus financing 40 to 100 megawatt deals right now, what is sort of the key difference at play right now?
Well, I think just the fact that you are competing them for a limited pool of cash.
Okay.
And actually the quality of your project is no longer a matter of binary good enough or not good enough.
Is that because the pool of buyers is limited, or the terms
the pool of tax equity providers is limited.
Okay.
Again, if you're north of pick a number, 100 megawatt, Bank of America and Citibank, the big European bank, they'll show up with big buckets of money at that point, and they don't want to get involved with the smaller projects. And so now you've got U.S. Bank and Wells Fargo and Union Bank, or kind of other, kind of the mid-size, or the banks that provide value, tax equity to the mid-size portfolios, and that's a smaller group. And now you have to compete with others for that bucket of money. And literally now it's just a matter of being good enough. You have to be better than the others, or have a better relationship, or you have to have some advantage to make you to stand out, because those banks aren't going to finance all the projects in that size.
Okay. And so, Peter, I know with the official announcement from the DOE loan program, the target for the different types of projects you guys are soliciting doesn't really have a preference for greenfield development of new solar PV, utility scale PV, or other renewable energy projects. And I'm curious, what were some of the key considerations that came into play that, made the DOE come to the decision that the funding gap doesn't really exist for utility scale PV at this point?
Okay. Well, let me step back a little bit to the large program that I think everyone in the room is familiar with, which was our 1705 program, where we did $16 billion of loans. That was an open solicitation, all part of the Stimulus Act. So these were loans made in 2010 and 11. The program stopped in 2011. It was an open solicitation for renewable power. It ended up being 80% of the projects that were financed were solar projects. Because of the state of readiness, it was really taking PV technology, which existed then in smaller scale, but scaling it up to over 100 megawatts. So that was the technology risk. This was all in 2010 when our banking system had a number of issues, so it was hard to get loans. And most lenders were not familiar with making $100 million loans to PV projects. And the average project size that we were dealing with of the 5 PV solar projects we financed, the average loan size that we took on was $900 million. So very significant loans. So we had a crucial role to play there because it was a technology that passed our technology assessment. It had not been commercially deployed at above 100 megawatts in the United States. And there were long-term offtake agreements. There was equity in place. These deals were all fully permitted, and they should have been readily commercially financeable. But no senior lender came to the table, not a bank, not an insurance company, or the bond market. Part of it was the financial world we were in, and part of it was just commercial banks aren't prepared to take on new project risk in the first, second, or third commercial deployment of a new technology. Yeah. That is what the Loan Program Office was established for in 2005. It was actually established, in hindsight, we forget this, but it was a Republican president and Republican Congress that established this program in 2005. And it was really to work with the private sector to overcome technology hurdles, demonstrate technology to the commercial sector, and then get out of the way and have the commercial sector come in. So we financed the first 5 PV projects over 100 megawatts, stopped funding in 2011, and since then, 10 new projects, PV solar, over 100 megawatts have been financed in the United States without a drop of federal dollars or state dollars. So that's kind of what we do. We did it in PV solar. We also are financing the first 5 concentrated solar projects, once again.
And Peter, not to step into, I'm curious though, just the logic behind not funding solar, or not having a priority towards new greenfield renewable projects at this point. Because as we know at this point, the pipeline of projects that are in development with a contracted PPA, it's around 13 gigawatts or so. And 97% of that is expected to come online by the end of 2016. And
yeah,
so what that speaks volumes about is how there's potentially still this funding gap, maybe not right now, but in 2 to 3 years from now, perhaps that issue does come into play once again.
Yeah, it's important to recognize ours is not a solar program. Ours is a new technology coming to market and being proved at a commercial scale.
Sure.
We did that with PV. There's no issue at all in financing a 100 megawatt PV solar project today if, and this is a big if you have an offtake, if you have an equity developer, and if you're fully permitted. It's a no-brainer to finance that. Any bank will do that. It's still a brainer to finance concentrated solar. That hasn't happened yet. We financed the first 5. The technology works. We're waiting for the commercial markets to pick it up. Where we are with the new solicitation, we think what can be helpful to the industry is how the solar industry can add ancillary services, essentially, so they can get the higher offtake agreements so they can make their deals financeable.
Right.
That's why we're so focused on the idea of storage and think storage is so crucial to the future of solar.
And we'll dive into some of the feasibilities of doing large-scale solar and storage in a bit. But I am curious, from the perspective of Hecate, as you're thinking about continuing to expand your pipeline moving forward over the next several years, perhaps not in states like Georgia and these sort of secondary tier markets, but when we look out west, for example, in California and the utilities there, and potentially for some other IOUs out west, a lot of these utilities are well stocked with solar PV and other renewables to meet near-term RPS obligations, and they're beginning to sign PPAs that start after 2017. And so I know that perhaps this is more of a theoretical scenario for Hecate, but as you guys continue to geographically distribute and consider, entering a state like California, which obviously is the #1 source of demand for utility scale solar, what kind of strategies are in play for you to ultimately generate revenue in the near term if you're ultimately able to sign a PPA that happens after 2017, but you want to make that project still eligible for the 30% level federal ITC?
Yeah, that's a tough question
sure,
to answer.
It's a $1 million question, I'm sure, for a lot of developers. But.
Yeah, and we are focused on the projects that are ITC eligible. Currently, those are projects that we are working on pretty much around the country. But some of the projects that I heard about earlier today, where they're using creative structures in which a particular utility has an offtake that starts a number of years out, I think that is attractive. We haven't come across any of those ourselves, but we do always look at creative ways to structure PPAs, and if there is a piece in which in a certain market it needs to make sense, if there is a merchant component to it for a certain period of time, we will look at it, but we haven't done anything like that until now. But we've done, since most of the people at Hecate are old utility people who've done a lot of other development as well, we've used those types of structures in other technologies. We haven't yet done it in PV, but it's primarily to bridge the gap between when the PPA starts and prior to that, if you have a certain period where you have to go merchant. Right. So we've looked at that, but we haven't done anything on that in solar space yet.
Okay. And so ultimately, why are you not doing it yet? I know the easy answer is that there's a huge amount of late stage projects in development, right? Is that ultimately the value proposition for you guys still, or is it the economics of merchant solar at this point don't work across the board?
From our perspective, from the deals that or the projects that we're looking at, it is the former. So we have a significant pipeline right now that has projects that do have a path to a PPA, and that's what we are concentrating on. But we have looked at certain geographies where merchant or maybe avoided cost makes sense. And those markets do exist within the US, where you have to go with under the purple rules and go the avoided cost route. We haven't done a deal, but we are looking at certain deals along those lines.
Right. And are there any particular markets across the US that make sense for doing merchant solar, where you're selling power into the spot market and the prices are proving to be perhaps more favorable than declining PPA terms?
I can't say definitively,
Okay.
but there are markets, and again, I think it's relatively easy to determine where those markets are. Those are markets that have higher gas prices from a locational perspective, and then also have relatively high spot electricity prices as well.
If I can jump in, it seems to me that I'm not sure why I would want to do this. I've heard this discussed before, and I keep going back to, well, if I'm bidding on a PPA that's supposed to come online in 2017, 18, 19, the bids are going to come in assuming 2017 costs and prices, which are going to, generally speaking, assume a 10% ITC. And so if I can make it pencil out with a 10% ITC and get it financed at the PPA price and with that level ITC, and I'm an experienced developer, financier, why would I not proceed with that path? Yes, I might be able to squeeze some more dollars out by going for the 30% ITC, but now I've just endangered my project by trying to be creative. And creative is not a good thing, frankly, in this context. If you can make it work safely at the 10%, I would do that.
Correct.
Right. I mean, the question is, can you be creative and safe? And I think we're beginning to see some examples and discussions about that, like in California.
Well, discussions. I mean, that thing is, I've seen one, merchant wind project of any size financed ever in this country, as far as I know. And I'm not familiar with any solar project of any size that's been financed merchant. And for good reason. They're not gas plants. You can't,
Well, as clarification, First Solar is developing the 22 megawatt
Yes.
Barilla solar project down in Texas.
And frankly, First Solar, as far as I know, is involved in black magic on many levels. There's many things they're doing that nobody else should be able to do. But understood. I mean, again, these are all things that are interesting discussions and can be done and perhaps will be done. But why would one? Why would I choose that, I guess is the point. It's one thing if I'm forced into that, if my choice is this, it's either that or no project, then okay, let's have the conversation. But if I can safely do a project that pencils at 10% ITC, I'm going to do that because I like safe.
Right. And I guess I'm going to play the devil's advocate here, because we are beginning
Sure.
to see developers think about this out in California, not just for solar, but other companies like 8-Minute Energy and Just Stamp. They're dealing with projects that are beginning to have PPAs after 2017 and are considering the option of potentially starting that project earlier. And what about the viability of doing perhaps a short-term PPA with a second off-taker? And how feasible is that? Because ultimately that's familiar to finance, and that's sort of the hybrid approach of being creative and perhaps still safe.
And it all could work, right? But now I got to have two off-takers to pass my credit evaluation, not just one. And that's twice the credit risk almost. But and now I got to find somebody who wants to sign a 2-year PPA, which is another problem. I can give them a good price probably, right? But there's no doubt it could be hobbled together. You could do this. You could find a good purple market, or you could sign kind of a handful of different PPAs with local munis or something, right? You could find a way to make it work. Now, but again, I come back to yes, I can, but do I have to? And if I don't have to, I'd rather not.
And I'll add to what.
I think the other, I agree completely. From a project finance point of view, selling merchant for a number of years gets you 0 credit in financing your transaction, so it's really not that meaningful. I think what you're pointing out to is how can you be a developer when the off-takes available are now at very historically low prices or going forward extremely low prices. So how can you make those pencil out for projects starting in 2017 or 2018? I think the assumptions you have to believe are the continuing dramatic decrease in all the costs, right? The panel costs and the balance of system costs. It's a huge area of the Department of Energy to drive that down. If you make assumptions about that, you can get to the lower cost. And a huge part that all developers knows is their cost of capital. Cost of capital is extremely high. Equity cost of capital is high because of the crazy system we're in with tax equity, and we're all held hostage to that. And then the cost of debt is high. So, but I see you're seeing real progress being made on both of those fronts. So there's been a big effort to get MLPs going, to make MLPs available for renewables. That hasn't happened, but the market has responded in these yieldcos. NRG is a yieldco, and 3 or 4 other developers are planning to begin yieldcos in the next few months even. And those are really synthetic MLPs, which provide a dramatically lower cost of equity capital. So if the investor in your project becomes a yieldco, you're going to be able to buy down your cost of equity, which means you're going to be able to survive and make your project pencil out at a lower offtake agreement.
Right.
So equity's coming down. Right.
And Peter, so just going along those lines, how scalable is a yieldco financial vehicle for developers? Because inevitably what you're doing is you're transferring one set of assets from your company's balance sheet into this other subsidiary LLC to expand your pool of capital, and that's nice, but is there potentially a trade-off or is there potentially diminishing returns on shifting all of your assets into a yieldco financing vehicle?
Well, look, these are early on, right? They've just started up.
No, right, recognizing that.
But the real value, as I see, for yieldcos are if you're a developer and you're selling your project, you now will have a number of active buyers of your project, assuming it's up and running. You've got to get through the technology risk. You've got to have an up and running project. So if you've developed and it's now up and running with a long-term offtake, you now have a dramatically more valuable asset than you did before yieldcos existed. So before, if you could sell it for a tax equity investor, call it a 10% return on the cash flow of the project, with yieldcos, you can now sell it for 15 or 20 times. So as a developer, your project is dramatically more valuable when there's a robust competition among yieldcos to attract assets into their yieldco.
Okay.
And that's the situation we're going to be in, I predict, in 6 to 12 months.
Okay. And so, outside of experimenting potentially with yieldcos and other financial innovations, on the partnership side, as you're thinking about how to replenish your pipeline with, a bit of this mystery box about how you can finance projects over the next several years, we've seen a number of examples recently where pure play developers are beginning to not only just sell off their assets to larger IPPs or utility holding companies or things such as that, but we're coming to this scenario where they're beginning to become acquired at a higher and higher rate. And there are a couple examples recently that have been pretty notable, whether it's Silverado Power being merged with S-Power, for example. That's a really prime example there. And so when you're thinking about your strategy at Hecate over the next couple of years, once you're able to sell off your pipeline of 30% eligible assets, what's left? Is it more reasonable to partner with a larger IPP to have that balance sheet to finance projects as you hit 2017?
From our perspective, I think that it's specific for every developer as to what their strategy is. From Hecate's perspective, we are aiming to remain in this business for the long term. And we obviously, project by project basis, it's an opportunistic industry where people, if there is an opportunity to sell a project, we will sell a project, but our intent is to maintain ownership and own and operate projects going forward. We developed our previous company and grew it relatively rapidly and sold that one and had to start again from scratch at Hecate. And the intent this time, or the strategy, is to hang on to it. From a financing perspective, yes, you're absolutely right. We will have to look at different markets to tap into for financing. And whether it comes from a strategic investor or whether it comes from financial, we don't know yet, but it's likely going to be from a financial, the way we see it at this time. And so I think it's developer specific as to what their strategy is. From our perspective, we want to remain in this industry and want to remain a player for the long term.
Right. And so, Morten, I know that you're sort of more heavily and intimately involved in that M&A space. I mean, in terms of examples you're seeing and conversations that you have with other developers, to what extent are developers concerned about surviving the market after 2017, and is really the best case approach to come up with an innovative financing scheme or to sort of partner with a larger IPP that has that balance sheet?
Well, I think every developer would love to have a sugar daddy, pretty much. I mean, I'm not sure that's changed. 2017 isn't necessarily going to change that. In fact, frankly, at the utility scale, I'm not sure that 2017 makes that big an impact in the overall strategies. I mean, all the numbers kind of take a shift in a direction, but it's not necessarily a qualitative shift. We've seen this for years. There's only so many truly independent, pure developers left in the world. It's compared to what happened in the wind industry 10 years ago, where the pure play developers stayed. That was a viable business model pretty much for the entire run of the wind industry. In solar, we've seen vertical integration from the beginning. Almost everybody who was a pure developer is now a EPC/developer, financier/developer, or a manufacturer/developer, and that's been going on for years, and I expect that to continue for the foreseeable future. Frankly, most of my pure developer clients are kind of always on the lookout for some type of strategic relationship. Because it's difficult to compete for all those reasons and more with the manufacturers/developers, who can source the less expensive equipment, or the EPC contractors who are willing to get paid only once instead of twice, and so forth. And so, but certainly a dropped ITC will just put more pressure on that. But again, it's a quantitative, just kind of, put all the numbers get pushed a little bit, but I'm not sure it's a qualitative strategic shift.
And so what does the buyer's market look like right now?
Who's the buyer? Which
for purchasing pure play developers' assets? Is it, shifted to an extent from what we saw perhaps a couple of years back, or what is the landscape there?
I think there's been a steady shift in favor of the buyer in that market, because there's lots of projects out there, frankly. But most of them are just really crappy, right? And then so if you've got a really good project, then you probably already had a buyer. But if you've got one of those medium projects.
So what do you mean exactly by medium in terms of what stage of development it is?
It's a project that isn't complete crap, but it's got a few flaws that need to be remedied. And you just need to find the right buyer for your flaws. It could be, maybe you've got a permitting challenge, maybe your off-taker it hasn't quite signed the PPA yet, and you need, or you can't get good equipment supply to fit your particular needs. There's several things, right? And if you find the right type of strategic buyer, whether it's a manufacturer who wants to put their modules in, or a big utility affiliate who can take care of the PPA for you. The buyers who now can essentially go and look for the projects that fit their flaw acceptability list, those project sellers only going to have a very limited options in terms of people who are willing to buy their projects. And they're going to be in a position where they have to take almost any project buyer they can find, because their timelines are always running out. Okay. So yeah, inevitably we see that the projects that are non-perfect but not horribly faulty, they're always pushing up against some time deadline, and that puts them in just in the worst and worst position. And if I'm the buyer, we ruthlessly squeeze them. Okay. And that's been getting more favorable for us for years.
And as one quick follow-up question to that, what is the project profile that some of the more innovative buyers are beginning to consider? So whether it's like a Google out there that's beginning to invest in projects, are they only looking for projects that are completed construction, or really just that vanilla, larger scale deal?
It's really all over the place. I have one new investor client I'm looking for now. We're looking for projects where they want bare bones early stage. They truly kind of site lease and PPA or less only. Just almost like a dream of a project. And we have buyers who really want they want to talk to you when you're almost shovel ready, and they'll buy when you're at completion. So it really is the full range because again, most of the buyers have a secondary motive or a primary motive, which isn't development, and they are either actually construction companies or actually suppliers or actually a finance company, and they want something that fits their primary need, where the development is really that's their secondary gain.
Okay. All right, Peter, and I want to take it back to you because I know earlier you mentioned how with the DOE loan program, a part of the prioritization in the next tranche of funding is solar plus storage for utility scale. In the commercial panel, we were talking about some of the trade-offs and feasibility of doing solar plus storage on the smaller scale. So what are some of the considerations for having a specific carve-out dedicated to prioritizing larger renewable projects potentially with storage, and specifically speaking to solar PV? Why is there a funding gap still for that right now?
Well, this solicitation is $4 billion, as I mentioned, which is less than the 16. So we were trying to think in this, how can we really back projects? And let me just say, we do debt for projects. Every project, we're a project finance lender, so a developer or a company has to come with at least 25 to 30% of the deal in equity. And we just take on the role of, we're a banker. We're the project finance lender to the project. Our term can be up to 30 years long, and we're basically whatever the US Treasury rate is plus a modest spread. So it's low cost, long-term financing. But the real value is we will back a project which other commercial banks won't. So that's the real value. So we try and think, how can we really back game-changing technologies? And in that, we're looking for technologies that are market-ready. By that, we mean technologies that have been deployed at really pilot scale. So they're through the lab, they're at pilot scale, but they've not yet been commercialized in any way, shape, or form. So we are doing the first commercial deployment, right? And then
although we have seen an example of, at least with CSP plus storage already, but that's a different ballgame.
CSP has been proven and deployed, and that Ivanpah's up and running, that works. Avango is Solana with 6 hours of solar thermal storage. Those are up and running and proven. So that's no longer the technology commercialization forefront, which is where we operate. Well, that's why we're focused on storage and grid integration, which we think is the next real way that we can be of service to not only the renewable industry, but the utility industry. It solves many issues if we as a nation can start solving the problems of grid integration and grid storage, whether it's battery storage, solar thermal storage. The other thing, one of the reasons that PV solar utility scale was so successful was because of the state energy mandates which came out at the time, which really allowed for the long-term offtake agreements. What California is doing now with its storage mandate, and what New York is doing with the storage mandate, the utilities there are going to be required to purchase storage capacity. That's going to happen later this year. It's our belief that there'll be many innovative technologies that will have received an offtake agreement, either directly or part of a parent company. And so if we can be involved in helping to finance those companies or those projects, that's something we're looking towards as a policy driver, which could really bring storage up to the next level. And if we can hope to prove out a couple of commercial technologies, then we also look for a technology, once we've proven it out in the first or second or third deployment, it really becomes very replicable across the country. And when you get to the replication stage is where the cost starts being driven down, right? Okay. So we're not so concerned that the first deployments are expensive. The first PV solar deployment is very expensive. The first CSP deployment is very expensive. First EV battery is very expensive. The first LED light bulb is very expensive. But once you get it deployed, the magic of the market happens and prices are dramatically driven down. Okay. So that's the goal of what we try and do, and that's really the intent of this renewable solicitation.
Okay. All right, so I know we're creeping on to 5 minutes left here, so if anyone has any questions, I just wanted to give some time here for...
Well, before we do that, we got to hone in on storage a little. All
right, for 1 minute response, and then we want to make sure we have some time for questions.
Just because, storage is one of those, nobody really knows what it is type of thing. I've had the grand joy of working, doing kind of early review of the California utilities form contracts for their upcoming solicitation, and it's almost hysterical to read because nobody really knows what they want or what they're paying for. Say storage. If you're talking molten salt, for instance, that's in some that's barely even storage. That's just like delayed release, right? It's just energy out just later, right? And an EV battery is really that is storage, but it's store energy in and then energy out. But a utility-attached battery storage system, it's so much more. I mean, it funds its energy in and out, right? It provides frequency response, and coupled with the appropriate power conditioning unit, can supply VARs and other kind of significant ancillary services, almost independent of the actual storage function. And those features, frankly, often have more value than the actual delayed release of the solar energy going in and out. And so it becomes a very challenging concept to even define what storage is, let alone figure out how you would actually integrate it with the solar facility or not. And so right now these licitations are going to be a riot, frankly, in a funny kind of way, in the sense that everybody is going to bid entirely different things, not different technologies, but different financial constructs and different service constructs, because these mandates are so undefined.
Right.
And the same things that happen, so when we're talking about detaching to solar, what does that even mean? Is it just a matter of kind of a thermal equivalent delayed cloud cover replacement, or is it actually something that provides additional services independent of the solar? And those are vastly different types of facilities.
And those are definitely all important considerations. And I just, being mindful of time, I want to see if anyone has any questions before
we're last.
follow up.
Were they going to kick us out?
One second, just to get the mic.
Yes, gentlemen. How come the old established utilities have not, jumped into the solar game and, seized control of the situation? Why have they not done that? And at what point do you think they might?
So just as clarification into the solar game, do you mean them?
Supplying the old solar power. They established the old, the coal generating facilities, everybody. How come they haven't started, gone solar?
Well, just, I guess to help frame that, I know that this is, they have been procuring they've been procuring large-scale solar projects, but perhaps there has been a drop-off. So is that, solely rooted in the drop-off in RPS-driven demand, or what else, other factors might be at play there?
And I'll answer some of it, but from my experience, you're right. They come in at a much later stage. Just the way the utility business model is structured, they tend to not take some of the early stage solar development risk. So they have, a lot of the utilities do have solar development arms. However, they come in much later into the game. So you're probably right that they don't do early stage, but a lot of the utilities do have significant late stage development and owning, operating of solar assets.
They'll get there, but utilities are inherently conservative and very, very conservative. I mean, if you have a conversation with the utility grid engineer, and he'll tell you no end of horror stories about what solar is doing to his grid, and the last thing he wants is an extra 100 megawatt put on there by his own guys, because now he's got to put in more non-rate baseable capacitor banks and all kinds of horrible things. And so there's a culture shift that needs to happen, and it'll get there eventually, but I wouldn't, not today.
Yeah, I would agree with that. I used to work for a utility and did not want to say that they're conservative, but yeah, you said it for me. Yes, absolutely.
You got out alive. That's good.
Yeah.
Okay.